Hi, folks. This is Nick Randall with the Life and Annuity Marketing Team here at Western Marketing. Today, we're going to be going over the differences of annuities and CDs and going through the basics, as well as some more details about interest rates and taxation. So today, we're going to cover quite a bit of information here. It's a relatively short topic in about 10 to 15 minutes or so. We're going to go over what is an annuity, what is a CD. We're going to talk about the characteristics of both products, interest rates, and the tax implications on these products as well. An annuity, by definition in of itself, is a fixed sum of money paid by someone to each year, paid to someone each year, typically for the rest of their life. And it is typically a form of insurance or investment, entitling the investor to a series of annual sums. That is the textbook definition of an annuity. However, annuities can be used for growth, and that's going to be specifically referring to today here with the multi-year guarantee annuities and CDs being kind of in the same accumulation buckets. The basic common elements of an annuity are a free look period, which is typically 30 days from after I receive my annuity policy. I can review that and decide I don't want to keep it and get all the premiums that I paid back in as a refund. They offer a death benefit, which is also known as a full accumulation value at death of the owner. And really, what that means is that the beneficiary would receive the full accumulation value. So if I had $100,000 that I put in, I had $10,000 in gains in my contract, for example, I pass away, my beneficiary receives $110,000 interest in addition to the principal. They do offer guarantees, CDs do as well, and then annuitization options. Typically not used so much anymore, but that is more of the income stream that annuities can offer. In addition, most annuities do have a surrender charge, CDs do as well, and we'll talk about those differences here. A CD, also known as a certificate of deposit, is a bank or credit union product that provides an interest rate in return for a lump sum, and it's paid out for a defined period of time. The common elements of a CD, they are typically 6 months to 5 years in length. There are durations in between that, and then they can also be longer as well. CDs are taxed as earned. So every year you have a CD, you get what's called a 1099 INT, and that is the interest form that the IRS provides, or that you file with your taxes, and that is the interest that you pay taxes on every year with a CD. Since they are bank or credit union products, they are FDIC insured up to $250,000, and they're designed for those looking for returns without risk. So it's a very safe and stable and type of product, and ultimately, it is something that somebody can, have guarantee rate of return on. However, the drawback to CDs is in low interest rate environments that we seem to have perpetually been on here in the United States, they do not credit very much interest. Typically, annuities will have higher crediting rates, and we're going to talk about why that is here. Fixed index annuities offer the potential for the highest rates of return, but they are typically longer contracts, 5+ years, even 7 and 10 years to get into greater products and different products out there in the market, but there are a few 5 years out there. There's also multi-year guarantee annuities, we're going to be talking a little bit more in detail about here, and they offer higher rates than CDs typically and are 1 to 10 years in length. And 5 years is usually about the sweet spot for the highest rates of return, the highest interest rate crediting. Now, CDs typically offer the lowest interest rates and are usually between, like I said, 6 months to 5 years in length. Now, how interest rates are determined are different on these two products, but they have some similarities as well. So the length of time until the CD matures, and that is typical with multi-year guarantee annuities in some situations as well. So it's basically the 6-month would offer a lower interest rate of return than a 5-year CD, for example. It also is based on the current interest rate environment, and also is expected based on the expected rate of return the bank would expect to receive over that given time period. Annuity rates are influenced by three main factors. The biggest is the 10-year Treasury. So the 10-year Treasury is a U.S. Treasury bond that essentially is the gauge on which we can see, interest rates increase or decrease in the market and based on multi-year guarantee annuities. There is typically a 30-day lagger time. So if we were to, for example, experience a large swing upside on the 10-year Treasury, we really wouldn't see multi-year guarantee annuities follow suit for about 30 days or so. It also is based on the current interest rate environment, and then it is also based on the insurance company's expected rate of return and on their float money. So that is what can actually give you a little bit higher rate of return. Taxation and crediting. CD tax consequences, like I said before, they are annualized. So every year you're going to have tax consequence that you're in a CD. So a 5-year CD, I receive 1099 INT every single year. Multi-year guarantee annuities are tax deferred products. Now, how that works is that you can get more growth because now you're earning interest on your interest. So instead of just my pure principal going and growing and having interest credited, I have interest plus my principal plus my interest going to work harder for me. Here's a little bit more. I put together this table here to kind of show what $100,000 principal deposit to give an idea of the differences. So this is 2021, and these are rates based on 2021, and these rates are probably some of the better rates out there when it comes to CDs. A typical 1-year CD is about 50 basis points. So that is 1/2 of 1%. That's a $500 credit to your CD if you put it in there for 1 year. Going all the way to a 5-year CD may pay 1%. I've seen higher, I've seen lower, but that's about the average, I guess I would say, here in 2021. And that's $105,023 is the actual accumulation value after 5 years of period. Look at annuities and look at the differences here. So a 1-year annuity is 1.5%. That's a $1,500 credit for just 1 year. A 2-year, 2.15. A 3-year, we have a little bit of setback of 1.95. 4 years at 2%, and then 5-year at 2.95%. These are big differences as far as total accumulation. So keep in mind, this is somebody who is looking for pure safety and they're willing to tie their money up for a given period of time. The 5-year over a CD would have $10,849 in additional interest by putting your money into a multi-year guarantee annuity versus a CD. That is a tremendous difference, and ultimately it is pure safety as well. Now, how can CDs be lower and so much lower than multi-year guarantees as far as crediting is concerned? Now, it's what's kind of the secret sauce of insurance companies is what's called float money. So float money is really a collect now and pay later. So the time difference and where the insurance companies gain better interest rates than a bank can. So what insurance companies do is they will collect all those premiums and they're expected to be paid out in a given period of time or a set period of time. They invest that money. And ultimately, that investment is really how insurance companies can grow the money more efficiently and better than a bank can. Typically, why we see higher interest rates in multi-year guarantee annuities versus CDs. In addition, if premiums were to exceed losses, that underwriting profit just goes right back into the float money. So insurance companies are always expected to pay out at some point in time, but ultimately what we're looking for is growth and consistent growth. And float money is used by all insurance carriers, not just life and health companies. It's used by property casualty insurance carriers as well, but ultimately is the driving force for higher rates of return within multi-year guarantee annuities. That concludes today's seminar here. Today we'll talk about life and annuities in more detail here and further events, but I definitely appreciate you taking time out of your schedule to listen to this call. Thank you so much.